Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend Matt, the lumberjack landlord. How you doing, buddy?
I'm doing awesome. Ready for number two.
Yeah, so we've been talking about a housing slowdown. I turned to the housing recession several months ago.
Yep.
As usual, the media has caught up with us. They're now having more and more articles talking about housing recession. So, of course, I want to change it and talk about what a housing depression looks like. Again, this does not mean a 50% crash in prices. I know there are lots of channels talking about a 50% crash in prices. I don't see it. I don't even see a 10% correction. Some do, like yourself, but certainly not a 50% crash in prices.
Yep.
I do now see, just like 1981 and 82, I believe, a 50% crash in transactions for both new construction and existing home sales, because I think the prevailing 30-year best credit, 20% down owner-occ loan, probably sometime in Q1 at the latest, has a 7 on it. And that's just going to decimate transactions.
It is. Yep, for sure.
What do you think of all that?
So a housing depression to me is me sitting in a home that I can't buy with the right rate and term.
Yeah.
That's a housing depression for me.
Okay.
I'm literally sitting in a house and I look at it and I'm like, I can't buy it with the right rate. I can't buy it with the right term. I can't buy it with the right terms.
Right.
And what's that house going to do? Well, if they have to sell it, it's going to drip and fall. If they don't have to sell, it's just going to come off the market and create tighter supply.
Yeah. You know, one of the advantages of actually having an econ degree and having really studied supply and demand, macro, micro, all these other various economics classes, is you understand that the housing market it's not like a TV. It's not like a computer. It has what's called utility, right?
Sure.
It's useful for other things.
Sure.
And it's not easily replaceable, right? A Sony versus a Samsung versus a whatever. There's also transaction costs. There's this thing called price elasticity. And then there's just math.
Yes.
So I think something we learned in June was that 6% 30-year money hurts.
Yeah.
It hurts.
Yeah.
30. And it hurts to the tune of 20 to 30%. It hurts. Hurts.
Yep.
Hurts.
Yep.
I now can sit here after Friday's Powell's speech and say, oh my God, I see a 7. And I see a 7 relatively quickly. We're talking 2 quarters. 2 quarters in a month.
Yep.
And so 7%, again, all these channels, they will be talking about demand destruction. And they're going to be right. If we saw 13 million people, according to Black Knight, who could be qualified at 3, not qualify at 6, what happens if that's 7? That's got to be like 18 million, 19 million, some big ass number, right?
It's a big, so it's that big of a number until prices start to track back.
If, right, as you believe they will, right? It gets better as prices come in, right? Because it's a combination of price, rate, and wages.
Correct. Yep.
So again, I think, something you will see in real estate is it's much, much slower than all of these crash predictors call.
It is.
So what's going to happen is I think rates go up fast. 6 months is fast.
It is.
And that's immediately demand comes off because you just get a no answer from a mortgage broker, right? It was yes, now it's no. That's fast. That's instant. Supply, not so fast.
Right. Right.
Because what's going to happen is you're going to have people that are in their homes who have equity, who would like to sell.
Yep.
Who would also be a buyer.
Yes.
So they're going to go shopping in a market where they probably want something bigger or nicer, which means more expensive. I think that's there will be some people that downsize, but let's talk about most people. It's often called the move-up buyer.
Move-up buyer, yep.
They're going to be looking around and going, hey, I could sell my house for X. I could buy theirs for Y. Their Y is more money.
Yes.
And, oh, by the way, we will be trading in a 3% mortgage for a 7% mortgage. I have done the math, Matt. For most people, that's going to be a 300% increase in mortgage payment. Yep. I want to ask you right now, what percentage out of 100 of people say yes to a 300% rise in mortgage payments?
Less than 10%.
Yeah, it's got to be single digits, right?
Yeah.
There's always going to be that person who had that liquidity event, who had an inheritance,
Correct.
whatever.
Correct. Yep.
They'll sign
100%.
up for that.
Yep. 100%. That's the only people that do
That's
that.
it.
And Mike, that's honestly like, admittedly, that's why I'm looking at 750 to $1.5 million homes in Las Vegas,
Right.
because those are going to be the ones that really crash.
That
They're
are
going to be the ones
stuck.
that really tumble, because
Too much
no
inventory.
no
buyers.
one's moving from that to the palatial pad where there's no real feeling of money.
Yeah.
Right. And even they have, decent debt, 2.5%, 3%.
Mm-hmm.
They're
not going anywhere.
It's not going. They're not going anywhere, because now they actually have a house that, with the debt on it, what makes it a great asset. Not just the house being an asset.
It's
the
debt
is what the asset is. Correct.
That is the biggest difference that nobody understands. I mean, the people that are saying, I actually have people on my channel saying this is going to be worse than 08. I'm like, how is that fundamentally possible?
Quick question. Were they investing in 08?
Yeah, probably not. No, they were
just trying to be fair.
Probably in high school.
Just trying to be fair. So, again, if you're going to tell me something's going to be worse than what it was, I want you to have experienced it, because you don't know how bad it was. Yeah. So when I talk to some of these agents where it's like, oh man, it's going to be bad, like 08, I was like, you have no clue what you're talking about.
Yeah. You know, what's really funny? Cause I bought before, during, and after.
Yeah.
Agents, I got news for you. This is going to be worse than 08. You want to know why? Because in 08, you had short sales and foreclosures. The banks were motivated sellers. They were paying full commission. Yeah.
Yes. Yep.
They were paying full boat. We are going to have demand and supply destruction as an agent.
I mean, I feel bad because obviously we connect with a lot of realtors. Right?
Absolutely.
A lot of them follow you, me. A lot of them are on the pages. I like to engage and talk with them. Mm-hmm. And right now, only a third of the markets, it's believed, are going to have a correction, but that number goes up every single month.
Well, here's the deal. I don't even think that's the most important thing. If you're in the industry, if you're an agent, a broker, a mortgage broker,
it's transactions based.
It's transactions.
100%.
You're already, it is already down 30% in existing. It went down 29.7% year on year. I would argue that's a crash. And when it gets to be 50%, that's a depression. If you're in the real estate industry, buckle up, Buttercup. It's about to get bad.
I talk to a lot of brokers, and some are friends and some are guys that I do business with. And what was really interesting was in the first quarter, about halfway through the second quarter, they were all on pace to blow out their number from even last year.
Mm-hmm. Yeah, I have friends like that too.
And
they're
now
like Q1, Q2. I had an agent that did. I want to be. I think they did 51 transactions last year, so almost one a week.
Yep.
Where I live, that's a very good living.
Yeah. Right. Hell yeah. Oh yeah.
We're talking an average price point of 7 figures. That's even if you only get one side, that's
living well.
That's living well.
Oh.
So heading into this year, so through May, June wasn't good, but through May, they had done 23 transactions.
Yep.
So they're like, hey, Michael, I don't know what you're talking about. There's no housing slowdown. Maybe in Phoenix, maybe in Vegas, not the Bay Area. They did 0 deals in June.
Oh.
0 deals in July.
Oh.
1 deal in August.
He's like, how's their September looking?
Yeah. Yeah, I don't know. He's like, Michael, I get it now.
Yeah.
I'm like, it's easy to predict. It was right out there in front of you. What are you doing?
My favorite agent, 99 transactions, 99 sides last year. 99 sides.
That's awesome.
Unbelievable. And he doesn't have a massive team. He's got 1 assistant.
Okay. That's 2 a week.
Yeah.
That's awesome.
He was crushing. I mean, I was 13 of those. So it's good.
Yeah, 10% of the business. Yeah.
I guess it's okay to have me as a customer.
Yeah.
He would agree. He would agree most
of the time. Yeah.
But yeah, I think he's looking at like in the 70s this year. 70s.
And if he took his rate post July 1, it's got to be down.
Oh, it's off a cliff. Because like I said, he was on pace to beat it in Q1.
Yeah.
About midway through Q2. So like April, like May, He was still on pace to really
Yeah.
actually beat it. He was going to absolutely
Yeah,
get over
and then
100.
June fell off a cliff.
And then June disappeared, July
Oh.
disappeared. But he was working on deals. But then I talked to him in July, and he said, I talk to him every week. But in that July timeframe, he was talking about, yeah, you know, it's been 6 years since I've been this slow. 6 years. And he goes, and 6 years ago, that was the first year he got his license.
Ah!
So only has license 6 years, but he's a machine. He's like top 10 in the state. It's a beast.
Wow. Yeah.
So, but yeah, a big adjustment for him.
Yeah. So again, I think a housing. Oh, the other thing that's going on, right? Because again, you go from 3 to 7, and let's say you're a person of means.
Yeah.
And you can, or you already own a second home, or you're going to move to your second home. I actually reported that this morning. 10% of LA listings are turning into rentals. 9% in Texas, 7% in the Southwest, which I think it's Phoenix and Vegas, and 4% in Florida. We're going to start to see more and more people just become, you can call it accidental landlords. So like, screw it. Yeah, why not? Right? Why not? Rents are going up. My fixed rate mortgage is an asset. Let's keep it.
Yeah, we're gonna have to have a course for them. So you think you can be a landlord? Eh?
Yeah, you need some hands-on mentorship from the lumberjack, especially out of area. Right? Can you imagine?
This is what I'm saying. Like they have, and again, it's going to be interesting to see, because will the increase, and because you just talked about 3 high tax states.
Yeah.
Will those high taxes impact the value, or will the values impact the taxes that then impact their mortgages? Right. In California, it won't, but in Texas and Florida, it sure as heck will, and Arizona as well.
Yeah. You know what? I want to poke at something, because again, you and I disagree about prices, and I want to give you some airtime. So again, you think we're going to have year-on-year price decline. So you're not here like some of the channels going month on month and seasonality and calling that. You're like year-on-year. Median price for the country is going negative sometime next year. You think it's summer? You think it's before summer, after summer?
I think we hit it before summer. Yeah, I think we hit it before summer.
So spring, probably.
Yeah, I think spring. Yeah, that spring market. I think you'll see
March, April, May.
Yep, I think you're going to see fewer listings.
Oh no, there's no question.
Right, I think you're going to see a tighter. I think there's going to be many fewer buyers.
No question. We're going to be at 7s then.
That's what I'm saying. So I called 6 by the end of the year, and we talked about 6 months ago. I talked 6 by the end of the year, and next year I said I think we're in the 7s. I think we get to the 7s.
Yeah, I think it. Yeah,
that's what I think happens. I still think everyone can slough it off. I was technically wrong on recession. However, my version of recession absolutely is happening in Q1 of next year, Q4 of this year, where it is. Jobs are no longer there.
Yeah,
that's the big thing. I think we're in those 4 or 5 categories of contraction. I still believe that for Q1 of next year. And I think, we're already giving back, right? We're playing with house money. We were up 16.6, and now we're up 10 or something, or 9.
Yeah, I think 10 was the last number. Still just barely double digits, like 10.2.
So we're already playing with house money. We're already down off the 6. Right. So we've given 16.
Oh,
we've already given 6 points back. And we're playing with house money. We're going to give more points back. Okay. But I think next year, we're going to have the beginning of this year to compete with.
Yep.
And prices are still going up in Q1 and Q2
no
in
question.
2022. So that's where I think that number, it could easily be Q1. It'll likely be Q2, but it could easily be Q1. Because while things drastically slow down in Q2 this year, next year, I think they'll be probably as slow. I still think that we have a chance of getting annual sales at 4 million.
Yeah,
or below. I actually called that we can get into the 3s.
I totally agree. I agree.
That's where it happens.
I think so. So. It's really cool. Again, we have one of the 3 amigos calling for a negative. Let's be very clear. Negative year-on-year price decline.
Yes.
At the country level.
Yes.
So this will be one of the. Next, let's be clear. 2023 will be one of 6 or 7 years in the last 52 years that posts a negative number.
Yes.
Okay.
Yes.
I disagree, which is awesome.
Agreed.
But it's again, for me, you again, we just disagree, and it's totally okay. To me, it's how long do rates stay at 7?
Agreed.
Yeah.
See, that's the thing though. They are pot committed right
Oh
now.
no, it may be 7 the whole year. It could
That's
be.
what I'm and so
Be.
not only could it be 7 the whole year, right?
Mm-hmm.
But now we're really talking about demand destruction. Now we're really talking about job losses. Now we're really talking right now. The recession is really only impacting the bottom part of the economy.
Well, that or people in real estate.
Right.
Like,
and so,
yeah.
and that's making a lot of people that were A class financial citizens that are going to be D class or C class financial citizens.
No, I agree.
So yeah, that's just the way I see it rolling out. I think we give back more this year. I think next year there's no solid number to run on. So I think we continue to decrease, rates going higher, inventory largely going to come on and then pop off. But there's going to be so many that are, listen, fear.
So let's play this out. Again, I love this. I love that we disagree.
Yeah.
And it's funny, we agree on a lot.
We do.
So again, we both agree that rates are in the 7s next year.
Yep.
We both agree that we might see something like 3.8, 3.7 total transactions, existing home sales, which is crazy low.
Yep. 100%. I remember when I first said it, you were like, what?
Whoa. I mean, because that would hurt, right? Go from 6.9 to 3.7. It's like
half. It's half.
But now I'm calling it. 50%. We're getting there. Yeah.
Yeah.
So, but again, let's play this out. And the reason, again, I just want to share my logic so everybody sees where I'm at.
Sure.
So when we do about 7 million, we're just going to use round numbers. About a quarter of that is cash buyers.
Yes.
So let's just call it, 7 million. Let's call it 1.5 million are cash buyers. Let's assume they get nervous. Their stock portfolios take a hit. There's not as many cash buyers out there, but there will be some. So let's assume there's, I don't know, 800,000 cash buyers next year. So that's going to be roughly 20% of the 3.7. So now we're talking about 2.9.
I think it's nowhere near that, just so you know.
Oh, okay. So that's where we did. Okay.
That's one of the major areas we disagree, because here's what I think happens. Where do those cash buyers come from? They come from pulling HELOC or equity out of other homes. They're not going to be able to do that because they're not going to want to touch their rate. Number one. Number two, HELOCs are largely going to be unavailable to investors and certainly to those
if
types
recessions, if a recession kicks in, they yank
and then
them.
Exactly. So they're going to yank those things. They're going to close them faster than you know what.
And
then the third thing is that I believe what also happens with those cash transactions is the people moving across state lines from more expensive stuff to less expensive stuff. Everybody's moved already.
Yeah, there's a lot of demand pulled forward. There's going to be this big air pocket for a couple of years. Again, the Fed broke housing.
100% they broke it. So that's why, based on those three things, I think the cash buyer, honestly, Mike, becomes almost non-existent.
So it goes like low. Okay,
really,
that's where we disagree. Okay, I like it.
Well, I think that's part of it. I think the other piece of it too is the market, because the Fed broke it, is not going to function properly.
No, that is exactly right.
So median price, right? Flat in the middle. That's what
median means. Yep.
Median, right in the middle. Here's the problem that we're going to have. Buyer incentive programs are going to be for first-time buyers.
Agreed.
That's going to pull median further down
because more transactions
there aren't going to be transactions
above.
occurring at any level on the higher side. That move-up buyer's dead. They're not going to go after that mortgage at 5, 6, 7. It's going to be that single-digit percentage. And so I think what ends up happening is the super high stops because their portfolios, their crypto, and their businesses have all either fallen off a cliff, collapsed, or are drastically down, and they're in wealth preservation mode. And they say, you know what? We don't need a third. We don't need a fourth house. We don't need to expand. What we have is fine. I think that move up buyer, that basically median and above, that 500 to $1 million buyer, they're not going to move unless they absolutely have to, because they have a note that's an asset on their previous home.
Agreed.
And they can't afford that double, triple payment. And then the worst is the government's going to come in, the handout administration. They're going to say, we think that housing should be around.
Housing is a right.
67 or 68%. And now we're at 64.
Right.
They're going to goose that market. They're going to give them maybe 0 down loans like VAs get that deserve it, deserve it.
Agreed.
And they're going to then goose it by doing that. And that's going to mean a pop in that bottom number, but it's not going to nearly make up. All the transactions now are occurring below the median. And that means that's going to drop. That's going to pull that number right.
Yeah. Down. If we lose half the high end, right, let's just put some numbers on it. I think the last median was like 413. Let's call it 400.
Yep.
So again, we lose 30% of north of that, right? You just whack off 30% of the bigger stuff, totally get move up buyers, stock portfolios, all that. Then we go to the low end and we go, hey, let's goose that.
Mm-hmm.
I mean, intellectually speaking, I get where you are, but here's where I cringe.
Yeah.
And again, I could be wrong. I'm wrong all the time.
Me too.
I don't see where the supply comes from.
Right.
So I think the
that's
artificial
the whole.
bump,
Mhm.
I think the artificial bump, because again, I see the demand, I see the handout administration, it's coming. I think the goosing of that is going to be larger than you expect, which is actually going to push some of those transactions above the median.
Yep.
And thus pull the median higher. It's not
Yep.
going to be healthy. It's not going to be right. It's going to be very artificial at the low end.
Mm-hmm. Mm-hmm.
That's where we disagree. So I think cash buyers are higher than you think.
Mm-hmm.
And I think we both think some handouts are coming, but I think there's just a dearth of supply that when you pour gasoline on a little campfire, it rages.
Yep.
And I actually think that pushes median up. You think it pulls median down. I love the disagreement.
Yeah, I think the last piece that I would add to that is what's going to change is DTI. So what's going to end up happening, and this is what I believe, is in that column or in that row of the market, in that sector of the market, I think where we're going to get hit the worst is going to be even the giveaway administration gives away that down payment, even though there's not a ton of supply. The issue is going to remain that you're still going to have a good credit score. And
real loans.
Real loans. The lending standard now versus what it was in 5, 6, and 7.
There wasn't a standard.
It's the difference between Pluto, the planet that doesn't exist anymore, and the sun. That's the difference in the distance.
I agree.
And so what people are looking at those deals and in those loans, I'm telling you, that's where I believe that all of those transactions start happening below the median, pulling it down. So even when you goose it, there's still going to be a bunch of people that don't qualify because they don't have the DTI and they won't have the debt to income that they need.
But they just forgave student loans and they were going to give back their cars and all of that will, yeah.
I mean, so again, with that 10%, with that $10,000, right? Let's play the game.
Yeah.
With that $10,000, how much more buying power does that give you? Not $10,000.
No, see, but again, that's what I'm going to talk to Matt, the mortgage guy, about. Again, it's reported multiple places that 20 million borrowers will have their entire debt wiped away.
Correct.
Which is going to impact their DTI. It's going to make it better.
Correct.
It just is.
But
I don't know how much better.
Right. But that's a payment though.
I agree.
That's a payment. So it might be, if it's $10,000,
their credit score is going up.
True. Yep. Their credit. So yes. But if I'm a gambling man, which I kind of am,
a little bit,
I think that they were also the stimmy ballers.
I think they were,
bought cars that have payments.
I actually want to go one step further. I actually think these people will be the next stimmy ballers. I actually had somebody ask me on my daily or the live stream, what do you think happens to housing? How many more people buy housing? And I think there'll be some, like right at the margin. I actually think new car sales go up. Because I deserve a new car because I got my college tuition paid off or whatever.
Good luck with that inventory. Like
I hate I deserve it stuff. It makes me
attitude of entitlement, which melds nicely with the giveaway administration. So it's gonna be a challenge to watch. But yeah, those are the pillars of why I think next year we're down and why I think median comes down.
And again, we'll be talking every week, so we will hold each other accountable. So I like it. Well, do me a favor. We have a very hot topic for number 3. I want to give it its due. Where can people find you as we wrap up number 2?
Lumberjack Landlord on YouTube and on Instagram, 11:30 a.m. Eastern time on Sundays. We do our live streams.
Awesome. Thank you so much.
Thanks, Mike.